Leveraged buyouts or LBOs, I guess this is a term that gets floated around a lot, so I thought I would talk about it, especially given the financial crisis of the last few years. So, what exactly is an LBO? Basically, if you want to buy a company and you borrow a lot of money to do so, then that is called an LBO. As you can see on the right, that's the structure of the value of the company after the company has been bought. There's a ton of debt, which is the money you borrowed to pay for the company, and that debt actually isn't taken on by me, the investor, but it's put onto the balance sheet of the company. So all the interest payments, all the debt payments are taken on by the company. And all the value that's left over, so the total value of the company minus the debt is the equity portion, and that's the value of the investor. So that's the amount of money that you initially put into the acquisition from your own savings. Another important point to notice is the purchase premium. As you'll see, the total value of the company or the total purchase price is usually above what the value of the company traded for before you bought it. And there's a few reasons for why this is so. Basically, having a purchase premium implies that the investor thinks he can add some kind of value to the company. There's one of the most important one is interest tax shields. So debt payments are actually tax deductible. So basically what that means is if you have a company that has a profit of $100, but then you take away 30 through interest payments, then now you're paying taxes on $70 as opposed to $100. So just that actually adds up to a lot and creates a lot of value. Another reason why someone might do an LBO is because they think they can manage the company better than the company was managed before. So that adds value. Thirdly, you might just think the company is undervalued and you're buying it on the cheap. And the last reason why LBOs are attractive to investors is because you're simply not investing that much of your own capital into this purchase. So how does an LBO work? One of the most important things most important characteristics of a company that you want to take over through an LBO is that it has really stable cash flows. Why is this? So that you can make the debt payments on a timely manner, and also if you have any extra cash left over each year, you can start paying down the debt. And as you can see, as the debt starts decreasing, your equity starts growing. And remember, this is your portion of the company. So even though the company didn't appreciate in value, your portion of the company grew, so you already made some return off that. Another way that you can make money off an LBO is if the value of the company appreciates. And then because you added on so much debt, you have so much leverage, then your returns are increased by a lot. For example, a small increase in the total value of the company actually generates a huge return for your equity, which is the only part you care about. On the other hand, you also take on additional risk. So if the value of the company starts decreasing, you could end up losing all your money. And the thing is, the company is still there. There's still 80% of the company, but the money that you invested is all gone. So you actually lost all the money that you invested. So now we'll go on to a real example. This is RJR Nabisco. This is one of the most famous buyouts. It was done in the late 1980s. RJR Nabisco was a food conglomerate combined with a cigarette distributor. So basically what happened was they were bought out for $25 billion all in one go, and this was by far the biggest LBO of the time. However, as you can see, they paid a really hefty premium of 67% for this transaction, and the thing is, there's a general consensus that they overpaid. The deal's still not done. They haven't exited their position, but in general, you would think that they just simply paid too much. And one of the reasons for this is actually strategic downsides for loading up your company with so much debt. The problem is you have not as much cash or revenues left over to invest back into the company because you have to shoulder this huge debt burden. And what happens is RJR couldn't upgrade its factories, its bakeries, blah, blah, blah. So then its competitors started to gain market share on RJR Nabisco. So finally, are LBOs successful in general? Here you have returns over the last 20 years for buyout funds or private equity funds and the S&P 500 index, which is a proxy for the market. So it's not that much better actually, and you may as well have just invested in random stocks. Yeah. Anyway, yeah, that's it. Thanks.
Okay.